Good morning, everyone, and thank you for joining us. My name is Antonella Vona. I'm the Region Communication Manager for Mediterranean and Africa, and I'm glad to see so many attendees today. The economy trends we saw in the first semester of this year seems to be confirmed. We are near a recession in Europe and a slowdown everywhere. But let's go listen more from our economist. And today we have 4 economists. We have Bruno Fernandes, Head of Macroeconomic Research, Marcos Carias, Southern Europe Economist, Seltem Iyigün, Middle East and Turkey Economist, and Chaudhuri, Aroni, Africa Economist. So before I leave the floor to Bruno, I would like to remind to everyone that there will be a recorded version of this session, and also we will send all the presentation to everyone. So thank you very much. Bruno, the floor is yours.
Many thanks, Antonella. So yes, well, basically here today we'll deal with so many topics, let's say so many risks, but also very interesting topics. We all think, as you mentioned, basically we are heading to a recession in Europe, also loads of topics, inflation, monetary tightening in the rest of the world. But first of all, I think what we have to look at basically is the commodity prices. Why? Because basically this was basically the starting point of this upcoming recession in Europe, of this upcoming deceleration at the global level, because, well, basically there was inflationary pressures from after the COVID crisis, let's say at the end of 2021, and of course with the war in Ukraine, all these pressures were exacerbated because, as you know, Ukraine and Russia are critical producers of many commodities like metals, like cereals, also energies. And basically what you can see here is that at the beginning of the war, the prices rise a lot, as you can see, soaring prices. But since then, I think what is the really interesting point is that the commodity prices went down, or at least some commodity prices went down. It's what you can see for the metals prices. And why did the metal prices decrease? Because of the recession fears. Because all the markets are expecting a recession, at least in Europe, and also a sharp deceleration in the US, and also, let's say, not a rebound in China. So it means that global demand will decrease, and so at the end, we think, and the markets think, that metal prices will go down because there will be less demand from construction, from industry. At the same time, as you can see, agricultural prices also went down. Maybe they are rebounding a bit, because we know that the harvest, for instance, for corn and other cereals were quite bad. Also because of the drought in Europe, the upcoming harvest will be quite bad, so we can expect a rebound. But for other commodity prices, you can see decreasing prices because of recession fears. This is what is bringing basically oil prices down, as you can see, was also these recession fears. But there we have, of course, the OPEC members, Seltem will mention it, that basically decided to cut the production to keep prices, to maintain prices quite high. So basically for all prices, we can expect them to remain at quite high level, which of course will fuel inflationary pressures all around the world over the upcoming quarters. And then, of course, the hot topic is the gas prices. Basically, the gas prices, as you can see, have soared and are very dependent on the flows that are coming from Russia and on the fears of, let's say, of supply issues. And we know that Russia just cut the gas supply to Europe through Nord Stream 1 at the end of August. And basically, we do not expect the supply to resume over the next month. So it means that basically we'll have tensions on the gas over the next months and maybe over the next years, and so that's why prices remain very, very high. And if we look basically at the upcoming energy crisis in Europe, the question is, if we will have enough gas or not in Europe this winter. And it looks like for the moment the inventories are quite doing well. Basically, we are almost full inventories, but we have to remind that basically we have only inventories for, let's say, 2.5 months for winter consumption in Europe. So it will heavily depend on if the temperature, if the weather is cold or not, and then also if companies and households will reduce voluntarily or not, let's say, their consumption. If not, we'll have to do rationing in some countries and for some industries. And so then the question will be that the issue is not only for this winter, because if we arrive at the end of this winter, let's say, with a very, very low inventories level, then the question will be, how do we refill, let's say, the inventories for the upcoming, the next winter, let's say, without the Russian gas supply? Because all through the spring and the beginning of the summer, we managed to refill the inventories thanks to its through imported LNG from the US, but also thanks to Russian gas. So if we do not have Russian gas over the next year, how will we do with these inventories? So basically, we can expect tensions on gas prices, and not only for this winter, but over the next year. So that's why you can see the futures prices are very high. So let's say huge pressure on gas prices, on commodity, let's say energy prices, but these prices will remain high for quite long. And so, of course, it's fueling inflation in Europe and all over the world, but here we'll focus in Europe. And you can see that in Europe, basically, inflation is soaring everywhere. We are reaching basically 10% almost everywhere. Not in France, where gas and electricity prices were capped in October 2021. But anyway, you can see very high prices. At the same time, what is maybe more worrying is that core inflation is rising a lot. So core inflation is when you exclude energy and food prices. And so basically it means that right now it's not anymore only an issue of energy or of food products. It's an issue, I say, because now inflation is broad-based. So it means that all services prices, all product prices are increasing. And so it means that basically now we have a broad base and it will last for longer, because right now it's not only, once again, an issue of commodity prices that maybe will stabilize or maybe will go down. Now inflation is all around us, so that's why it's spreading, and so prices will remain higher. And the issue is that, of course, inflation is being fueled also by the depreciating, by the weak euro. What you can see here is that euro basically went below $1. It's been depreciating for many months. And why? Well, the first answer, let's say, is the recession fears, because everyone basically is fearing a recession, or let's say tougher economic conditions in Europe than in the US. So basically we are selling euros. And at the same time, the issue is that basically this weak euro is making, let's say, European imports more expensive. For instance, we are buying oil in dollars. So basically weak euro means that more expensive oil prices for all the European countries. So that's why also, for instance, the trade deficit is rising a lot everywhere. And so basically it means that inflation is getting higher. So what can the ECB do? Basically rising interest rates. And you can see that it has started a bit later than in the UK or in the US, but also the fact that it started later made basically a difference in between the two interest rates, also, let's say, exerted pressure on the euro to get depreciated. So basically right now the ECB will have to raise interest rates as much as possible to bring inflation down, because we can see right now that inflation is not temporary anymore, and it will heavily depend on, let's say, on the depth of the recession. If we have a sharp recession, then maybe, of course, it can bring inflation down. But if not, then definitely the central banks will have to raise interest rates really strongly, and as you can see, as in the US, in a very sharp way to bring inflation down. But it will mean, of course, higher financing costs for everyone, for companies, but also for governments, for households, and so, of course, it will affect heavily the demand. And of course, it's not only an issue and a matter for European countries, because as you can see here, basically the US, so the Federal Reserve, is tightening really sharply its monetary policy. You can see here that basically when we compare, let's say, the tightening cycle with the previous ones over the last 2 decades, basically this is the most aggressive, because basically here you can see that it has been raised by 3% the interest rate over, let's say, in 6 months, while the previous times it took maybe 1 year, 2 years to reach this level of tightening. So basically it's very aggressive and it's exerting loads of pressure on all the central banks. Then of course Aroni and Seltem were also mentioning to also follow suit. Why? Because otherwise their money will depreciate even further. It's what we can see in the euro, but then they will show you also it's the case for all the other currencies. For instance, the pound is also depreciating a lot, and all the other currencies. And so that's why, as you can see right now, if we look at, let's say, the rate cuts and the rate hikes, now everyone, basically advanced and emerging economies, are increasing their interest rates, with maybe right now only 2 exceptions: Turkey, Seltem will also, of course, mention it, but also China, because in China we know that there is a sharp deceleration in activity with a real estate bubble, and we can see that the zero COVID strategy is also affecting activity with huge uncertainty that basically is affecting consumer confidence, business confidence. And so at the end, for the moment, we do not see a recovery in Chinese economy, and so that's why the central bank is trying to support activity, cutting rates, but it's an exception. All the other, let's say, major central banks are tightening. So once again, we will see deceleration in activity and in demand in, let's say, all the major economies. And so in this quite turbulent context of, as I mentioned, energy crisis in Europe, but also rising interest rates, inflation, of course, right now, once again, this quarter, with the barometer that was released yesterday, we have more downgrades than upgrades. Basically, you can see here, once again, many downgrades, not that much in Europe because we think that we did the job already last quarter, but you can see right now that many sectors that are dependent on, let's say, on the energy as an input cost, like chemicals, like metals, like paper, are being downgraded, not only in Europe, but right now at a global level, because of these energy prices that will remain high for long. At the same time, you can see that we have also downgraded construction sector, because of course it will be affected by this environment of global tightening. And of course, if construction is doing bad, then it means that the wood sector will also face an adverse environment, because of course there will be lower demand for the wood sector. And so that's why we have downgraded almost everywhere, and we know that the prices of metals and of wood have been decreasing steadily over the next months. Why? Because of lower demand from construction. So that's why, as you can see, many downgrades because of the energy crisis, because of the higher interest rates, and also, for instance, for the retail sector, because in Central and Eastern Europe, inflation is skyrocketing, and so it will affect households' purchasing power. And in terms of countries, once again, despite the fact that during the last quarter, the previous quarter, all the major, let's say, downgrades were made in Europe because of the upcoming energy crisis that we anticipated. Once again, 6 out of 8, let's say, downgrades were decided in Europe. Marcos will talk about maybe the most important one here, which is Italy, but also, for instance, we have downgraded Denmark, Switzerland, Luxembourg, because we think that in this very adverse environment in Europe, no countries can be at A1, which is the lowest level of risk, the very low level. Only Norway right now in the world is at A1, because as you know, they export gas, so basically for the moment they are doing well. It's a positive environment for them. But for all the rest of the countries in Europe, A2, let's say, seems to be the lowest risk of level because very adverse environment. Also, we have downgraded Egypt. Aroni will talk about that. And Chile. Why Chile? Because Chile basically 52% of its exports, it's copper. And we know that the outlook in the short term for copper is quite bad because of high energy costs and at the same time lower demand from construction. So Chile is not doing well, and so we downgraded Chile from A3 to A4. But in the rest of the world, for the moment, despite this hard environment, we have not downgraded. So for the moment, it's all in Europe. But once again, we have to wait over the next quarters to see the impact at a global level. And so in this environment here, you can see our new forecast, our updated forecast. You can see that we expect a sharp acceleration in the global GDP growth. We can say that we are in a global recession. It's admitted that basically below 2% growth, it's a global recession. And of course, it's mainly due to, let's say, you can see negative figures in Europe. Definitely, we expect Italy and Germany to be more affected than other countries because they are more dependent on gas, more dependent on Russian gas, but also in the UK, very adverse environment. France, maybe we will be a bit less affected because less dependent on gas and so on, but you can see definitely we can expect recession in Europe this winter. And then in the US, deceleration because as you saw, the Fed is tightening really sharply. In China, we expect a very, very small rebound, but as you know, 4% growth is really low growth for a country like China. And so, of course, with all, let's say, all these drivers that basically are not helping the GDP growth, it means that GDP growth will be way lower than first forecasted. And then Spain, maybe to start to talk about, let's say, our region specifically. In Spain, we expect a 0.8% growth. It's quite low growth, we can say, sharp acceleration, but still positive because we think that Spain and Portugal, for instance, they will keep on benefiting from the recovery of the tourism. Because as you can see for the moment, it was what we were mentioning over the previous webinars. Spain is lagging and is still lagging behind the rest of the countries, let's say, in Europe, in terms of recovery after the pandemic, because the economy was still 4 to 5% below the 2019 growth GDP, let's say, still at the end of the Q2. And why? It was, let's say, because of the tourism, because the tourism was still, let's say, recovering, and it's still, even this summer, it was 10% below 2019 international arrivals. And so we can expect that definitely it will keep on recovering. And you can see that in Portugal, for instance, if we compare with Portugal, there the tourism has rebounded way more strongly. It's really hard to know if this is a new trend, if really right now some tourists will go to Portugal instead of Spain, because, for instance, from British, let's say, tourists, we have minus 15% in Spain, and they all came back to Portugal. So maybe right now the British tourists are going more to Portugal than to Spain, but we have to wait over the next months, over the next quarter to know if this is the new trend or not. What we can expect definitely is a continuing recovery of the tourism in both countries. So basically it will support, let's say, the activity. It will allow these countries, let's say, to keep, let's say, a positive growth, and maybe below 1%, but still a positive growth. The other thing that, let's say, the other factor that will help maybe Portugal and Spain, if we compare with the rest of Europe, is that basically they are benefiting from cheaper gas prices, because as you may know, basically there is a market, a MIP gas, so a market of gas in Portugal and Spain, where prices are a bit lower now, because basically there are cuts in Russian supply in Poland, in the Netherlands, in Germany, and in the rest of Europe, but it's not affecting that much Spain and Portugal. Of course, they are buying for very high prices, let's say the LNG from the rest of the world and from the US, but still at lower prices than the rest of Europe. So high prices in Spain, but in Portugal, but a bit lower than in the rest of Europe. But still, as you can see, the trade deficit is huge. It's increasing a lot. We are back to, let's say, the financial crisis levels because of the very high energy bill in both countries, because once again, prices remain very high. You can see that if we compare with 2021, we are basically 6 times above. And the other issue, let's say, for Spain is that basically the households there are being heavily affected because, as you can see, the disposable income has decreased over the crisis, during the pandemic, but at the same time, it didn't recover at all. Let's say we never got back to pre-crisis levels. While in France, in Italy, in Germany, let's say the households recovered, let's say, their purchasing power. In Spain, it was not the case. And right now, of course, we are entering in very high inflation figures, low wage increase. And so what you can see here is that people have to save. Basically, they have to spend their savings. And so that's why here you can see that we are getting trouble because people, they don't have margin, let's say, don't have a leeway to take their savings to spend. And at the same time, their purchasing power will decrease. And in this context, of course, of high inflation and let's say upcoming recession, you have to look, let's say, at the green lines. The green lines is the consumer confidence. And the consumer confidence, as you can see, is very, very low. It's at its lowest since, let's say, the pandemic, since the financial crisis, since the sovereign debt crisis, both in Spain and in Portugal, but actually it's the case everywhere in Europe. And so what happens when the consumers have no confidence? Let's say when their outlook is so bad. Well, the fact is that household consumption decreases a lot. It falls because, of course, people have no confidence on the future. And so basically what they do is that they cut their spending and basically they just do precautionary savings. So you can see here basically very low consumer confidence. At the same time, let's say lower disposable income. So it means that consumption will fall in Spain, in Portugal, and in the rest of Europe. And so just to finish this presentation on Portugal and Spain, and before leaving the floor to Marcos to talk about Italy and Greece, just a few words on business insolvencies in Spain. You can see that basically they remain quite high. Actually, Spain is an exception in Europe because insolvencies have been rising, let's say, from the end of 2020, while in the rest of Europe, insolvencies remain really low until right now. And to be honest, right now, they are rebounding a bit, but remain very low. In Spain, they have increased from 2020. And you can see that right now, maybe what is interesting is that it's not only because of the hospitality sector when we compare to before the crisis, but also right now because of construction, because of manufacturing. And we have to mention that it was even before the raise in interest rates. So it means that basically we can expect higher insolvencies in construction in Spain because interest rates will affect, let's say, the new permits, the new buildings. And at the same time, right now, we can expect the retail sector to also suffer more insolvencies because consumption will fall. So once again, here, what we can see, we can expect in Spain and Portugal to be maybe less affected than the rest of Europe because of thanks to tourism, thanks to a bit lower gas prices. But at the same time, these countries will suffer more insolvencies and, let's say, once again, deceleration in activity. And now I leave the floor to Marcos.
Thank you, Bruno, and for your presentation. And now we leave the floor to Marcos Carias. Thank you, Marcos, for giving us some outlook on Italy and Greece. Thank you.
Thank you. So before I go into the weeds of Italy and Greece, let's just take a minute to think at a very high level about how this energy crisis compares to the most recent experience of crisis and difficulty, which is the pandemic crisis. And I have prepared here a little table, kind of summarizing the situation. If you can go to the next slide, Bruno, please. Yes, there we go. Thank you. So Bruno was showing you these trends in business insolvencies that we saw in Spain. He said that Spain is one of the exceptions in Europe of countries that have seen insolvencies go back to their pre-pandemic levels. Of course, this means that elsewhere in Europe, except for maybe the UK, we're still seeing levels of insolvencies that are under what we have in 2019. In Italy, if trends stay the same during the rest of the year, we're going to finish 2022 with levels of insolvencies that are still 10 to 15% under under the pre-pandemic levels. And of course, this phenomenon, we have seen it because, as we know, the governments responded to the crisis, to the pandemic crisis, with very strong support for businesses in the forms of things like guaranteed loans, of furlough. So the big question is, are we going to have this again with this crisis, or is this crisis really different? And are we going to see insolvencies growing to reach again the levels of pre-pandemic, or even go even further? Well, to answer this question, I think it's very important to look at the broad context, because if indeed it is true that governments are yet again putting a lot of support that in its form, in its measures, is a little bit different from what we saw last time. Last time we had guaranteed loans and furlough. This time we have a lot more kind of tax measures of reducing, for instance, in Italy, the VAT on gas, of giving businesses, SMEs that have high energy bills, tax credits, things like this. This time also, the support for the fiscal support is a lot more stronger on the side of the consumer as opposed to businesses. So this question of are we going to have more insolvencies is really hard to tackle. So let's go step by step. What are the differences between the environment? Well, first of all, the thing to take into account is that we are now in a world, of course, of high inflation, and as Bruno showed, a world of high inflation is also a world where central banks have to raise interest rates, also a world where central banks have to stop doing quantitative easing. So we know that one of the big things that the central bank did during the last crisis to help the states was doing the pandemic emergency purchase program for the case of the ECB to buy bonds. Now there is no new quantitative easing program. There is the reinvesting from the excess money from the PEP, but no new pandemic program. And this is because central banks have made it their main vision to fight inflation. I also think it's important to consider that this is a crisis that is happening a lot slower in its manifestation, its materialization, than the last crisis. So, of course, we have been warning about the negative effects of the Ukraine crisis, of the Ukraine war, and the energy crisis for 3 quarters now. But if you look at the GDP numbers in Italy, for instance, they are still quite good. We had 1% growth in Q2. Q3, as we know, because this this phenomenon of the tourist recovery is also expected to be very good. So in terms of GDP, the crisis is not hitting yet. But again, because of these trends that we see in consumer confidence, even in business confidence as well, we expect that the winter is going to see where we start seeing these effects materialize. But in terms of the response of the government, this also means that the governments can go a little bit slower and see as they go progressively how they can help businesses and households to the same strength that the crisis materializes. Compare that to the pandemic, where during the pandemic we had all the worst happen at the same time at the very start of the crisis. As we all remember, Q2 2020 was the worst economy. Everybody was so afraid. And so the governments didn't have time to think. They just threw as much money as the problem as they could. And they could because they were facing a deflationary environment and they had the support of the central banks to do this. So to some extent, that led to a bit of, let's say, spend the money first and ask questions later. We're going to verify if these are viable companies, non-viable companies. Let's just try to save as many people as we can right now. And that, I think, to a large extent, explain that insolvency paradox that we saw. It's important also to consider who is on the front line of this crisis and how the crisis manifests. Back in the pandemic, the fear was that because you had this huge demand shock, this huge revenue shock in the services sector, there would be so many insolvencies and therefore so much unemployment. So what did the government do? Is they did things like furlough schemes, the ERTES in Spain, Casa Integrazione in Italy, to protect jobs. Because let's always remember that what the governments care the most about always is protecting the people. So here is a different crisis because it's hitting, in terms of companies, the most energy intensive industries first, and then it's also hitting the purchasing power of households. And that means that a lot of the fiscal intervention of the governments is looking at containing the inflation felt by the households, by trying to contain retail energy prices, for instance, and maybe a little bit less at supporting businesses and supporting jobs and employment. Actually, the employment situation continues to be quite good because labor markets are very tight. Last but not least, we should look at the GDP numbers that we're forecasting versus what we saw in the pandemic. The contractions during the pandemic were a lot more stronger than what we're seeing with GDP numbers, but this can be misleading in terms of what might happen to companies. Why? Because during the pandemic, what we saw essentially, most of all, was a revenue shock for companies, a sudden and intense decrease in how much they were selling, because all these services companies, but not only services companies, they couldn't sell because there wasn't contact with the consumer. Here, we have a crisis that is as much about supply as it is about demand. So we have, at the same time, we are going into a period where revenue is going to decrease, but also where companies have been suffering so much on the side of the cost, and this is really putting a constraint on the cash that companies are being able to generate. We see that the fiscal response of the states is consequence, because these amounts that the states are investing to protect their economies in terms of GDP are consequential, between 5 or 10% of GDP, depending on where you go. Really, the outlier here is Germany, which of course unveiled their mammoth plan to protect the German economy just a couple of weeks ago. And this allows me to do the transition to Italy. If you can go to the next slide, because this stuff that is happening in in Germany, and also the UK, is having consequence on the outlook for Italy. I will explain now how. Because as we all know, Italy, the main big risk that is behind everybody's head when you think about Italy is the risk of a new sovereign debt crisis. Because we all know Italy's debt to GDP ratio is around 150%, second largest in the Eurozone after Greece. A lot of this debt is also in the hands of financial market participants. So Italy is definitely open to a speculative attack if investors in the market was going to lose strongly confidence in the sustainability of public finances, and not dissimilar to the one that the UK is suffering right now. So why is what is happening in Germany with this huge fiscal response maybe bad news for Italy? Because the message that this sends is that whereas the crisis response fiscally during the pandemic in Europe was very unified, here we see a manifestation that the main fiscal sponsor of the European Union and of the Eurozone, which is Germany, if European countries, the ECB and the Commission, can raise debt on the market with credibility, is because it's the German fiscal credibility that is underpinning that. Well, we see a will of going at it on their own in response to this energy crisis. So this creates doubts over how unified Europe will be in the future. as this stress of the crisis becomes increasingly stronger. And also what we see in the UK, because as we know, markets are manifesting that they don't they're not going to be so lenient on unsustainable fiscal policies as they have probably been in the past. When the Liz Truss government presented their mini budget with their underfunded tax cuts, markets say we don't buy it. Now, Italy has the advantage that it is part of a larger monetary area, that the Eurozone is the Eurozone is protected by a huge central bank, the ECB, that we have, of course, the transmission protection instrument, the anti-fragmentation tool that was unveiled by the ECB this summer, saying that if necessary, they will protect. They see the spreads raising, which is what I have in this graph. In this graph, I have like the spreads of the bond yields between Germany and Italy. If those spreads are rising as they have been rising beyond a certain point, they will intervene. So all of that contains the risk a little bit. The other element that has casted doubt into the sovereign risk is also the political risk, namely the government change that we saw recently, where the government of Mario Draghi, which of course inspired a lot of confidence in the Italian economy, collapsed, and now we have a right-wing coalition in power in Italy. Now, one positive development that we have seen with this right-wing coalition led by Giorgia Meloni is that they have manifested a will to be more conciliatory towards Brussels. This is a party that has been historically had a Eurosceptic kind of discourse. They have moderated that discourse a lot and manifested a will to find a compromise with Brussels because Italy is so dependent on European funding to lead its economy. And also, more recently, there has been apparently a rather smooth transition with the Draghi government. Meloni has even apparently been seeking to put technocrats at the head of key ministries like the economy minister. So these are all definitely good signs. The question is, how stable will this be? How stable will this be? Because right now, Meloni is coming into government. She has to show that she is competent, that this government will be competent. But also, as the cost of living crisis intensifies, and as she will almost certainly lose popularity during the next year, she might have the temptation to go back to her populist roots. And as we all know, in Italy, the average duration of a government is always 1 year. Even Draghi broke records by lasting a year and a half, and that was a lot. So the main risk is also this continued political instability in Italy, and it's something that we have to keep an eye on very closely. Lastly, I want to say a couple of words about Greece. So Greece is an economy that has seen good developments over the last few years. As we can see in the graph here on the left, where I show the spreads for Italy and for Greece, even though Greece has a debt to GDP ratio that is closer to 200%, it has been increasingly showing a restored confidence by the markets because we have now a government that is a lot more cooperative and a lot more business friendly than what we used to have at the times, in 2015, where we had Syriza and we had the doubts about is Greece going to stay in the Eurozone or not. Is not Greece of the 2015 anymore. They have seen a lot of development in many respects, but even all of these structural developments with structural reforms have not been able to shield Greece from this energy crisis, even though Greece does not depend significantly directly on Russian gas for direct energy provisioning. They have a big dependence on oil, on international oil for their energy supply. And of course, they cannot escape the rising of prices in oil and in natural gas, even if they don't source it directly from Russia. And so we see inflation rates in Greece that are around 12%. even if the average rate in the Eurozone is 10%, they have not been able to escape. And this, of course, hits the Greek consumer, who, even if they have seen some good years, even if they are benefiting from the recovery in tourism, are still, their balance sheets are still damaged by this huge depression that Greece saw during the last decade. It's for me a good example that because of these international linkages, nobody escapes from the energy crisis. Last but not least, the political outlook in Greece. We saw that the Mitsotakis government was a key factor in this improvement of the business climate in Greece. Recently, there was a wiretapping scandal. Basically, the parliament is investigating whether or not the Mitsotakis government had spied on one of its rivals, and though this has created some amount of tension with Brussels, it hasn't really affected public opinion as much as we probably would have thought. Next year is an election year in Greece. What is more relevant is that in the next election, Greece, there is one rule that is going to be cancelled in Greece, which is that normally the first party to win the election gains 50 additional seats out of the 300 in the House of Parliament. This rule will be suspended, and so the Mitsotakis government, even if it wins, is highly likely that they will lose their majority. So there will be coalition building, which might prove a little bit difficult, and so there's a risk that after next year's elections, soon we might find ourselves in snap elections. So this political stability that has characterized Greece recently might be a little bit eroded. That is about all that I have to say for Southern Europe, and we can continue with the webinar.
Thank you very much, Marcos. Now we give the floor to Seltem. She's going to talk about Middle East and Turkey with an economic outlook. Seltem, the floor is yours. Thank you.
Thank you, Antonella. Thank you, Marcos. So I will start the presentation with the Turkish economy. Well, Turkish economy grew by 7.6% in the second quarter, and in the first half of the year, it had an average growth rate of 7.5%. Of course, the biggest contributor to this growth was the private consumption, but also in the second quarter, net exports added 2.7 percentage point to the growth. Well, after the strong growth performance in the first half, we revised up our GDP growth forecast for Turkey to 4.3% from 2.5% previously for this year. However, for 2023, we expect a slowdown in the economy, mainly due to the slowdown in the private consumption because of the high level of inflation. Well, on the other hand, in the third quarter, we started to see that the industrial production has started to decline. Actually, the growth, the expansion of the industrial production has started to decline. In the third quarter, the industrial production is estimated to have declined by 5% after a small increase of 1% in the second quarter, and the PMI index actually stood at 46.9 in September, indicating that a more marked slowdown in the third quarter of the year. And internal and external demand conditions both remain challenging, while there is a continuous increase in the input cost, as you can see in the second graph. If we can move on to the next slide, please. The economic struggles in the Eurozone will also have an impact on the Turkish economy through exports. Well, because Germany and Turkey are on the same supply chain, Germany's order are a good prediction for the Turkey's production level in the upcoming period. So we expect the slowdown in Europe, particularly in Germany, to have a downward impact on Turkey's industrial production, as suggested by these two charts. Well, you can see there is a close link between the EU consumer confidence and Turkey's capacity utilization rate. This is quite expected because the Eurozone and well, the European Union actually is Turkey's largest trading partner. So normally the fall in EU consumer confidence should have an impact on the Turkish capacity utilization rate. However, we estimate that strong tourism revenues and also 2 increases in minimum wages this year were able to support production so far this year in Turkey. So if we can move on to the next slide, please. You can see that the biggest challenge for the Turkish economy would be related to the inflation level. The central bank shocked markets by cutting its policy rates twice in August and September to 12% from 14%. And now the policy rate stands 71.5 percentage points below the annual inflation rate. So this has a deteriorating impact on the inflation expectations, which increased by around 14 percentage points since the start of the year. We expect the annual inflation to peak around 90% as of November and average at 75% this year. Next year, we expect average inflation to stand at 50%. And the only downward impact may come from the base effect this year and decline in some commodity prices because of the decline of the growth rate globally. Well, in September, the annual inflation rose to 83.5%, which was the highest level since September 1998. Annual producer prices rose to 151.5%, suggesting that we will continue to see pass-through impacts from high level of production costs. And this time, actually, the price increases are spread across all the categories of the sub-components of the main consumer price index, including energy, food, services, and goods. And we believe that inflation would be stickier than the central bank expects. Still, we expect the central bank would cut its rates below 10% in the upcoming months to support the economic activity. Here, the key risk would be related to the tightening of the domestic credit conditions to corporates. On August 20th, the central bank announced new measures meant to address credit availability to corporates in order to keep inflation in control, including higher reserve requirement collaterals for lenders. And following these measures, we estimate that banks may be more reluctant to provide loans to companies as they will be requested to park a certain sum of collaterals in the central bank, and the lending mechanism so far has become very complicated. If this happens, companies that roll over their banking loans by making interest rate payments may struggle for their cash flow and working capital needs in the upcoming period. So if we can move on to the next slide, please. Well, another risk for the Turkish economy would be about its current account deficit level and the way it is financing. In January, August period, the current account deficits jumped to $40 billion from $13 billion a year earlier, and total energy imports rose to $56 billion from $27 billion again a year earlier. In the same period, the current account balance excluding energy was in surplus of around $14 billion. So our view is that Turkish economy will record a current account deficit of around 6% of its GDP this year and 3.5% next year. And our current account forecasts mostly factors in the country's rising energy bill, which will only partly be offset by the increase in tourism revenues. Actually, in the first 8 months, the tourism revenues almost doubled compared with the same period of last year. Turkey is growing links with the Middle East and Russia may result in a higher level of capital inflows. However, when we look at the way the current account deficit is financed, we see that there is an increasing role of the net error and omissions item. Well, because of the other traditional financing sources like inflows related to the portfolio investments and foreign direct investments are declining, we see that the share of the net errors and omissions is increasing. So in the first 8 months, the capital inflows coming through this item financed 70% of the current account deficit. This increases the risk of further depreciation, the risk of the further depreciation of the lira, and because the financing of the current account deficit is becoming more volatile and unpredictable. If we can move on to the next slide, please. Well, regarding Israel economy, economic activity in Israel remains strong, and the GDP has been above its trend line for the past 3 quarters, according to the central bank. And the surveys continue to show that businesses remain positive for their situation, and GDP is expected to increase by 5% this year and 3.5% next year. Furthermore, indicators for the third quarter continue to show a high level of economic activity. In contrast, we expect the slow to moderate next year due to expected slowdown, as my colleagues mentioned, in the European and global economy next year, and also a higher level of interest rates domestically in Israel. This would weigh on investments through a weaker level of investor confidence, I would say, and tighter financial conditions. While the PMI data suggests there is a slowdown in production and increase in input prices, which is not very surprising given the global environment, and the decline in new orders is related to the slowdown in global trade. If we can move on to the next slide, please. Well, the central bank hiked its rates to 2.75% in October. We expect the central bank to continue with these front-loaded policy rate hikes in order to move the inflation between its target of 1 to 3%. Israel's annual inflation stood at 4.6% in August, after reaching a 14-year high of 5.2% in July. We expect the inflation to average at 4.5% this year and 2.5% next year. Well, we expect the upcoming November 1st legislative elections in Israel to produce, well, actually no clear winners. However, actually, although we think that this situation would weigh on the fiscal balance of the country, because it will make difficult the process of passing the budget for the next year, it would have very negative impact on the economy. So if we can move on to the next slide, please. Well, with the outlook for the GCC region since our latest webinar remained quite flat, this would be the only region that will benefit from the high level of energy. Actually, rising energy prices will help to support growth in this region and improve the fiscal balances. Despite the economic diversification efforts, we know that the GCC region are still dependent mostly on hydrocarbon revenues in order to run their economies. That's why actually during the last quarter, we revised up our GDP forecast for these countries between 2 to 4 percentage points. And this quarter, we maintained them. We didn't change them. And well, as previously mentioned, we consider that most of the GCC region, most of these countries will reach their GDP level of pre-COVID period, except Kuwait, which would have some delays because of the challenging political environment. The increase in oil production would be the key driver of the growth, as we expect it to increase by 12% this year after decline of around 6% in 2020 and a slight increase in 2021 of 1%. Regarding the other impact of the current geopolitical situation, we can see that actually the inflationary pressures will continue to persist in this region related to the high level of economic activity, strong domestic demand, spillovers from the World Cup in Qatar, and recovering in tourism revenues, and also high level of energy and transport and food prices. Well, for example, in Saudi Arabia, the inflation edged up to 3% in August from 2.7% a month earlier. It was the highest reading since June 2021, and these factors that I just mentioned will continue to be to play out actually in the upcoming period for all the countries of the region. Regarding the United Arab Emirates, risks are on the upside for our CPI estimation of 4% after Dubai's inflation that reached 7% in July. Other factors that I just mentioned will continue to affect the CPI level, and so the credit conditions in these countries will continue to be tightened because of the central bank's willingness to follow up the US federal footsteps because of strong GDP growth performances, high level of inflation, and also the monetary policies that are linked to the US monetary policy because of the currency peg. So I will stop here and leave the floor to my colleagues, and thank you so much for your interest.
Thank you, Seltem. And now we go very fast to Africa. So the floor is yours, Aroni.
Yes, so speaking of Africa, well, I want to start by replacing Africa in this global context and to see how the countries in the continent are doing, basically. So on this first map, we have we want to visualize the difference between our growth forecasts for the year 2023 and the average annual growth rate of economies between 2015 and 2019. The reason we take this pre-crisis period is because we want to take off the bias of the pandemic shock and the 2 years of somewhat strong recovery after the shock in order to have a growth trend to which we can compare the current position of growth for global economies. So what we can see on this map, so shades of blue indicate that the trend it is below trend or that the differential is negative, and the shades of green it's that the differential is positive, so it's above trend. So as you can see, for most of the world, growth forecasts for this year are below trend, and this is for all the reasons that my colleagues explained to you before. However, we can see that in Africa there are actually many countries countries that are above trend. And that is also reflected generally in the growth forecast for Africa that you can see everywhere. So what is the reason behind this? So one of the main reasons is also because when we take this period of 2015 to 2019, we have to realize that in this period there's a sub period, the 2015 to 2017 period, which is the period that just follows the end of the commodity super cycle that ended in 2014, and that was a period that was quite rough for some African countries, especially obviously commodity exporters and oil exporters. So in that sense, countries like Nigeria or Congo or Angola have growth trends that are actually above their pre-crisis trends because they have because the recovery from the pandemic and what happened on the oil market kind of bolstered their economic perspectives. Then you also have countries that had big political crises during that period, which obviously affected their growth, and those countries have now a somewhat or relatively better position, Sudan, Burundi, and then you have other countries that simply have caught up to their previous growth trend, meaning that the effect of the pandemic has been broadly balanced. But another thing that we have to take into account with this map is that basically all of the markets that Africa depends on, because Africa and African countries still remain quite dependent on external markets, are below trend, are in a situation of inflation, of monetary tightening for the advanced economy, of even recession. So this obviously, despite growth perspectives that are still positive for most of Africa, the outlook is not that great. Bruno, if we can move to the next slide. So when we look at our average growth for Africa for 2022 and 2023, it's broadly stable at 3.5%, but it is lower than our forecast before the war, which was around between 3.8 and 4%. Obviously, this is not a very good sign. The reason is that the African population grows at around 2.5% per year. So obviously, real per capita income growth is actually not increasing very fast, and that obviously entails problems regarding inequalities and the increase of extreme poverty, as well as entailing political risks, which are obviously major in Africa. On the chart on the right, I've made some growth projections with some very simple hypotheses to show you what actually the impact of crises like the COVID-19 crisis or the war in Ukraine can do on growth in countries like Africa. And as you can see, the red curve, which is our current outlook, which would be an average annual growth rate of 3.7% in this 8-year period to 2030. Well, the GDP level at the end of this period would be approximately 3% lower than what it would have been without the war, and approximately 8% lower than what it would have been without the COVID-19 crisis and the war. So while the effect of the war and the current environment might not be extremely large in the 1 or 2 following years, it will add up because of the nature of growth and also because of how African economies are structured. So this is just to give you an example of how crises end up costing in the long term. And obviously, when you put this in real GDP numbers, we are talking about hundreds of billions of dollars at the end of this decade. So now that we've had an overview basically on the perspectives for Africa, I want to spend the rest of the presentation concentrated on 3 countries specifically, because there are interesting things that are happening, and also because they represent 50% of African GDP. So from north to south, we'll start with Egypt. This is the important one because we lowered the country risk assessment from B to C. This is mainly due to the pressured domestic outlook for Egypt, and this pressured domestic outlook is mainly due to what is happening in its external accounts. So what happened in Egypt is that in the first quarter, there was a financing need that appeared in the balance of payments of around $7 billion. And this was due to the fact that the international reserve, foreign exchange reserves of Egypt depleted very quickly from around $40 billion to around 33 currently in between March and July. So this is basically due to the very nature of how the Egyptian pound is an administered currency, and the fact that the central bank of Egypt had to intervene on the markets to maintain the parity of the pound with the US dollars when there were external headwinds, such as capital outflows, such as the soaring import bill because of high food and energy prices following the war in Ukraine, as well as the fact that Russian and Ukrainian tourists make up approximately a quarter of the total of tourist arrival in Egypt, and obviously the war greatly disrupted that, lowering export revenues. So these interventions obviously led to the decline of foreign exchange reserves. In order to stop this bleeding, what the Egyptian central bank had to do is that it had to let the pound depreciate. So first by a forced devaluation in the month of March of around 16%, and then in the month of July, letting the pound return to a free depreciation, quote unquote, because it is a managed float regime, so that these pressures on the reserves kind of abate. And additionally, and you might have heard about this, they have also created some import restrictions in the forms of the letters of credit that are required by importers now from their bank to import goods, because they also want to compress imports in order to spare their international reserves. Now, obviously, this does constrain the outlook for Egypt, mainly because the fact that now the pound is depreciating and we expect it to depreciate by another at least additional 16%. That is because that is one of the requirements that would be necessary for an IMF agreement. Obviously, that is fueling inflationary pressures. As you can see, the inflation rate, it has started to increase again after abating a bit in June. That is mainly because of this depreciation of the currency. You can see also that core inflation is now moving faster than headline inflation. It is because food prices have somewhat eased, while with these import restrictions, we now also have supply issues on basic consumer goods, as well as the effect of the depreciation of the pound. Now, because of this, the Central Bank of Egypt obviously had to hike its interest rates. So currently they stand at 11.25%. They did not decide to hike it further at their last policy meeting because they want to see how the monetary policy transmits to the economy before deciding on more rate hikes. However, it is possible that due to the current situation and pending to deal with the IMF, because that is ultimately what the Egyptian authorities are looking for. It's something that they've done before in 2016. That is to say, let their currency depreciate in order to obtain financing from the IMF and then rebuild a reserve and then be able to have a currency that appreciates. So all in all, this constrains the outlook for Egypt. Now GDP growth is forecasted by around 4%, down from around 5.5% before the war. And obviously, while this is done in a somewhat controlled manner, it still exposes some of the external imbalances of Egypt. So it does expose it to the current environment, which is why we downgraded it from B to C. Moving on to Nigeria, the largest economy in Africa. And so in Nigeria, we are facing kind of the same issues as elsewhere in the world, which is high inflation and rising interest rates. But in Nigeria particularly, this is also greatly due to the difficulties of its oil sector. Because while the oil sector in Nigeria actually does not represent that much in terms of weight in GDP, because it's around 6.6% of GDP, whereas the non-oil sector is 93% or above, the fundamental role of the oil sector in Nigeria is a source of foreign exchange and also of government revenue. And as you can see, the average daily oil production of Nigeria is now close to 1 million barrels per day, which is basically 800,000 barrels per day below their output defined by the OPEC at 1.8 million barrels per day. And all of this is mainly due to oil theft. Obviously, there had been some problems of underinvestments in production capacities after 2015, 2016, but mainly the current problems are related to oil theft. So just 5 days back, the Nigerian authorities found an illegal oil pipeline that was siphoning oil from an export platform, and that sparks protests in the street. And so because crude oil exports are not at the level that they should be, basically it's pressuring the naira. There's a shortage of dollars because people would rather exchange their dollars at the many parallel exchange rates that Nigeria has rather than the official exchange rates, and that is continuing to fuel inflation, which was above 20% in August. Nigeria being very very heavily dependent on food inflation, but as well as on fuel inflation, because they import a lot of refined petroleum products. And right now, the crude exports are not balancing out at all the refined petroleum imports. So there is a deficit in the oil bill, and which is all fueling inflationary pressures, and which is basically adding to the same kinds of headwinds that other economies worldwide are facing on domestic consumption as well as on investment, because of monetary tightening that the Central Bank of Nigeria has to undertake in order to cool inflationary pressures in the medium term. Now, the good point with Nigeria is that its non-oil sector is actually doing quite well, as you can see on the graph on the right, and basically it's the growth driver. So while Nigeria's oil sector is necessary to the economy, as we all know, it is not the driver of Nigerian growth. And in that sense, agriculture, services are doing quite well. Nigeria has many booming industries such as fintech. So really, the outlook for the Nigerian economy is not that bad, pending the fact that they can solve the issues of their oil sector, which are necessary to stabilize their external position. So that is the key message. Finally, moving to South Africa, so the second largest economy, and the third that we want to cover. In South Africa, the nature of the problems are a bit different. So there is an energy crisis in South Africa, but this energy crisis is not the type of crisis that we're talking about in Europe, although South Africa is affected by high oil prices, mainly because oil is very important in many industries, as you can see in the chart on the left, but mainly because of electricity supply. And the electricity supply issues in South Africa all stem from the situation that Eskom has been so the main power utility, the main electricity supplier, distributor, and producer in South Africa, has been for the past 5 or 6 years. You can see that many of the South African industries, the important ones such as mining, such as agriculture, such as iron and steel, even food processing, are very dependent on electricity supply. And since electricity supply is so erratic, and it has been load shedding incidents have been so important in the past month, that obviously this is affecting most of the South African industries, and so which is creating supply constraints. And on the other hand, there is still a high inflation in South Africa by its standards. So it might have peaked in the month of August, but given the fact that the rand is continuing to depreciate quite steadily, I would say that it's possible to see inflation increase again, especially since now we have the decision of the OPEC can put some pressure on oil prices, and fuel inflation is actually one of the main drivers of South African inflation. So in that sense, you have the domestic outlook and the domestic consumption outlook that is constrained by high inflation, and the South African Reserve Bank, which is very orthodox in the way it conducts its policy, will keep hiking rates. So right now it stands at 6.25%. I think that it will go above 7% in 2023. Incidentally, that also would follow the Fed's hiking path. So in that sense, you have both supply and demand constraints in South Africa, which is why the growth forecast is at 1%, and which is basically above the long-term potential of South Africa, which is around 1.5%. And one key risk for South Africa is also the fact that global trade is expected to contract quite a lot because of this crisis. And South Africa is an open economy with some of its flagship sectors really dependent on exports, such as automotive and agriculture. So that represents a concern for the years to come, as well as adding obviously pressures onto the rand. So basically, I'll end on this. This is just to tell you and to show you that how the 3 largest economies in Africa are all suffering from structural constraint and are all under pressure regarding their external position. And so you can imagine that if these 3 big economies and these 3 very important economies are suffering these type of headwinds, that smaller economies are even more exposed. So while the growth outlook is not bad in Africa, risks are definitely increasing. And so just like in the rest of the world, these are developments that we'll have to monitor in the medium term. Thank you for your attention, and I'll give back the floor to Antonella.
Thank you very much. Thank you for all our economists for this interesting presentation. We had a lot of information, high inflation, rise interest by central bank, a lot of downgrade, some winner as Norway, that is the only one in A1, but also some good news in some area. So I start this roundtable with Bruno. Bruno, some good news or positive news for the end of 2003 from your side?
Maybe. Let's say that it will heavily depend on, let's say, on the energy developments, because basically I think that at the global level it's possible, you know, that thanks to the monetary tightening, then inflation is curbed a bit, and so then of course, let's say it will be a heavy shock for many countries, many households there, because they will lose purchasing power. But then if, let's say, commodity prices let's say go down, and because of the recession, for instance, in Europe, they go down for quite long, then inflationary pressure will ease, and then it's true, we can expect a rebound in activity in some countries, in some region, by the end of next year. Then, of course, the question in Europe is a bit different, because in Europe, it's a question of inflation, of monetary tightening, but also of energy, also of gas. And here, as I mentioned previously, I think it's quite complicated, because we do not see, let's say, an end, or let's say a quick end to this war. And so it means that basically the relationship between Russia and the rest of Europe, or Western Europe, will remain really complicated for the next months and for next year. So it means basically that we'll have to live without Russian gas, without Russian energy for quite long. So basically it means that it's likely we'll have energy supply difficulties into 2023, but also 2024, and that prices will remain high in Europe, energy prices for 2023, 2024. So basically it means lower competitiveness for, let's say, all these countries, for all the exporters. It's true, we can say, well, we have a weaker euro, so it means that basically more competitive. But the issue is that, let's say, the input prices are rising so much, and energy price is way higher, for instance, in Europe than in the United States or in the rest of the world, that at the end, all the companies that are using energy as an input, they are losing competitivity, they are less competitive right now because of energy prices, and despite the fact that euro is weaker. For other sectors, it could be that at the end, if they don't use that much energy, that inflation goes down, then at the end of next year, they will recover. But once again, it will depend heavily on sectors and on some regions.
Thank you very much. We go to Marcos. Marcos, why is Italy so in debt if it has such strong industry? And of course, we have a really huge number of small, medium companies in all our countries. So what is your point of view?
Yeah, this is something that a lot of people don't really know, but like the two heartlands of European industry are German Mittelstand and the north of Italy. So this might seem puzzling. Italy is actually in many ways, in many sectors, very competitive and groundbreaking economy. The problem when we talk about debt is that you're not talking about just one section of the country. You're talking about the whole country. You know, you're talking about and for all the strengths of the northern Italian economy, there are many weaknesses in the south. You know, in terms of productivity and in terms of employment and everything. So the thing is, like, European welfare states, and by the way, this is not only an Italian problem. We know that debt in France or in Spain is also huge, not as big as Italy, but you know, above 100% of GDP. It's because European member states, European welfare states, you know, they were made during the 1970s, and they need high rates of growth to be sustainable without debt. And actually, the debt that we've been incurring has managed to pave over these deficiencies over the last few years. But now that we are going into a world of monetary tightening, getting into that is going to be a lot more difficult. So the theory is that what you need to do now is just make your economy more productive in order to get back to high rates of growth. This is the whole theory behind the Next Generation EU and all these structural funds. But of course, if we're getting crisis after crisis like this, and we have to use the structural funds to pave over short-term stuff, this is going to be difficult. So yeah, you can be very productive and at the same time be very much in debt, unfortunately.
Thank you very much. And Seltem, what would be the biggest risk for Turkish economy ahead of the 2003 elections?
Well, I consider that the biggest risk would be related to the credit availability for corporates. As I said in the presentation, the central bank is cutting its rates, and we expect it to continue to deliver further rate cuts in the upcoming period. And in order to prevent the loan expansion to be inflationary, the bank introduces the macroeconomic, the macroprudential tools, and this makes the for banks the credit mechanism very complicated. That's why banks may shy away of providing loans to corporates. So the authorities are trying to compensate this this unwillingness, I would say, of the banks to provide loans through state guaranteed loans. So I think that this package would be very important. Otherwise, we can see corporates to struggle to meet their cash flow and working capital needs. So that would be the first biggest risk. And the second one would be, of course, related to the inflation pattern. And so we expect the inflation to slightly ease next year, but this would be mostly related to the base effect. So the monetary policy stance will be important. And the third risk would be related to the way of financing of the current account deficit. As I said, now most of the financing is made through net and omission items, which has a unpredictable and volatile character. Well, next year we expect the current account deficit to decline to 3.5% of GDP, so the financing pressures would be easier. However, this will continue to present a risk.
Yeah, thank you very much. The difference between other countries is that Turkish, unfortunately, is used to fight inflation, and for the other countries is bad news. Let me say like this. Let's conclude with Aroni. Aroni, regarding Africa, what can African economies do in the current context to return stronger in the growth?
Well, the one answer I have, and I think the main tool that they need to develop for African economies is proper governance. We have been saying this for a long time now. Economists have been stressing it, organizations have been stressing it, that good governance is what unlocks Africa's potential in the medium to long term. And this is because Africa already disposes of a plethora of natural resources, has a young and growing population. It will be the second largest continent in terms of population by 2050. And also, it can also benefit from the shifting of some value chains, for instance, textiles from emerging Asia towards middle income and frontier markets in Africa. It's already happened in countries like Ethiopia. So there are opportunities. Obviously, there's also hydrocarbons. There are opportunities in many fields and industries, even in fields like ICT. I was mentioning fintech with Nigeria, but the tech industry in Africa is actually doing quite well. But what it needs to really grow is an institutional framework, a business environment, a security environment, a political environment that is stable enough for these industries to grow, for investors to regain confidence in Africa and in African countries, to be able to generate the type of financing that is needed for these industries to develop. And lastly, I would also add that there is also the grand idea, quote unquote, of a integrated regional African market. So there are steps that are taken in that direction, but obviously it's a country, it's a continent of 54 countries. So the potential for an integrated market and what it would bring to African economies is really enormous. Progress on that front is quite slow because there are still large actors, notably South Africa, notably Nigeria, that still have their cards to play in the game of trade. But eventually there will be a more integrated market in Africa, and that would greatly benefit the trade between African countries, and also very importantly reduce their reliance on major global actors like China, like the US, like the EU, which will shield them a bit more from external shocks, which is what is affecting them the most right now, as we saw during the presentations. So those would be the tools that Africa would need, and these are things that are already being explored. One thing we can only hope is that political crisis, climate crisis, and debt crisis, security crisis do not damage these economies too much in the medium term, because those are risks that are definitely increasing.
And with this wish, we are closing our webinar. Thank you for your participation. Thank you to our economists. You will receive a recorded version of presentation of the today webinar. And we invite all of you to follow us on our website and social media to be informed with our publication and the latest barometer that we issued yesterday. We will have next webinar mid-November, so we'll wait for you, and thank you very much for for your attention. The webinar is closed.
Bye, guys.
Bye-bye. Thank you.